Lesson number 8, Liabilities. What's going on, guys? In this lesson, we are going to learn what are the two classifications of liabilities, what are the examples of specific liability accounts. Just like assets, liabilities are classified into current and non-current liabilities. Current liabilities are liabilities to be paid or settled within 1 year, while non-current liabilities are liabilities to be paid or settled beyond 1 year. The 1-year condition is the same as what I had explained in the asset discussion. Any liability payable within 1 year is current liability. More than 1 year is non-current liability. There's more to this definition in advanced accounting topics, but this simple explanation is sufficient to lay the basic foundation for future advanced accounting discussions. What are examples of specific liability accounts? Under the current liabilities category, we have accounts payable. Accounts payable are debts to suppliers. Not all the time, the business has the cash to buy its products or services from its suppliers. If the business has an arrangement with that supplier to buy products or services without paying for them immediately, the business has purchased them on credit. Notes payable are debts to suppliers with a promissory note. This is like accounts payable, but supported with a promissory note. It allows the debt to be documented and offers protection to both the lender and then the borrower. Accrued expenses are expenses incurred but not yet paid. When the business receives the bills for electricity, water, or internet for the current month but payable next month, or when the employees had already rendered their service for the month but payday is on the next month, it should record them as liabilities this month. We call them accrued expenses. Any service already availed by the business but will be paid next month is a liability or accrued expense for the month. Accrued expense is just an accounting term for liability or payable. In our examples in the succeeding lessons, we are going to use the term payable. Unearned income is income already collected, but the product or service is not yet delivered to the customer. Unearned income is a liability. It is just another term for that. When the business collects money from a customer, but the product or service has not yet been delivered, the business should record a liability or unearned revenue. It is a liability because no product has been delivered or service performed yet. Who knows what will happen, so until the product or service has been delivered, there's still a liability. What are examples of specific liability accounts under the non-current liabilities category? One example is mortgage payable. Mortgage payable are debts usually to a bank with collateral. When the business purchases an asset like a building or land using money borrowed from a bank, normally those assets are used as collateral or security. This collateral serves as protection for the bank just in case the business fails to pay the loan. This type of loan usually involves large cash, so banks want to feel safe. This loan is called a mortgage payable because it is supported by a collateral asset. Bonds payable are debts to bondholders. Bonds are applicable to large corporations. Sometimes they need cash that banks and other lenders cannot provide. What they do is issue bonds. It is an agreement that the corporation will pay whoever gets these bonds the amount stated in the bond plus interest. The business gets cash, but will have to record a bond payable until they pay them in full. Long-term notes payable are debts to suppliers with a promissory note payable beyond 1 year. It is similar to the notes payable we had discussed in the current liabilities category. The only difference is that it is payable beyond 1 year. Just like assets, the number of liability accounts depends on the nature and needs of the business.